They told you America's financial crises were accidents, random, unpredictable, unfortunate mistakes made by overly optimistic bankers. But what if that entire story is a lie? What if the economic chaos you lived through, your job losses, your shrinking savings, your rising rent, your impossible mortgage, your drowning debt weren't the symptoms of a broken system, but the intended outcome of a system functioning exactly as designed? Because today, we're redigging into one of the darkest truths in American financial history: how Wall Street created crises to control America. Not metaphorically, not symbolically, literally engineered, structurally baked into the machinery of money itself. What you're about to discover is not the story they teach in economics class. It is not the version of events repeated on the news. It is not the narrative approved by the Fed, Wall Street, or the political establishment. This is the version buried in footnotes, hidden in court transcripts, silenced in boardrooms, and erased from public memory. Before we dive in, where are you watching from? Drop your country or city below, because this isn't just an American problem. This is global. And if you want the unfiltered truth, the kind of financial revelations YouTube really doesn't like promoted, hit subscribe, because this is only the beginning. Now, let's pull back the curtain. What if the 2008 collapse was not a failure, but an operation? To understand how Wall Street created a crisis to control America, we need to go back not to 2008, but to the early architecture of American finance. Because what happened in 2008 wasn't an isolated disaster. It was the continuation of a blueprint written over a century earlier. Let's start in 1907. The Panic of 1907 is often portrayed as a chaotic financial meltdown. Banks failing, markets crashing, the public terrified. But behind the scenes, the crisis handed two entities unprecedented power: the J.P. Morgan banking empire and the political momentum for a centralized Federal Reserve. A private banking titan saving the system from collapse. Sound familiar? Because when we fast forward one century, we watch the same playbook unfold. Crisis leads to panic, which leads to consolidation, then centralization, and finally, more power for the very institutions that caused the collapse. But let's go even further. In 1929, the Great Depression obliterated American wealth. But not everyone's wealth, because while the public lost homes, farms, savings, and livelihoods, the largest financial institutions mysteriously expanded their reach and control. Again, crisis, consolidation, control. Are you starting to see the pattern? Now let's jump to the 1970s. America abandons the gold standard in 1971. The dollar becomes a fully fiat currency. This means banks can create credit without the restraint of physical reserves like gold. This moment is critical because it's the turning point where the financial system becomes not just unstable, but engineerable. From here onward, the economy is a machine, not a natural ecosystem. A machine built with switches, levers, and pressure points that can be controlled by those who understand its deepest wiring. Enter Wall Street's new toys: derivatives, credit default swaps, securitization, and off-balance sheet entities. These are synthetic financial products designed not for safety or stability, but for pure extraction. And behind all of them, a new invisible empire emerges: the shadow banking system. A system with no public oversight, no democratic accountability, no meaningful regulation, and no transparency. A system that doesn't need to hold actual reserves and has the ability to create leverage far beyond what traditional banks could ever dream of. By the 1990s, this shadow system quietly surpasses the entire regulated financial system in size. By the 2000s, it becomes the real financial system. Now pause. Remember what they said about 2008? No one saw it coming. The models didn't predict it. It was a once-in-a-century mistake. But look at the history. Every century, every decade, every financial transformation, every single unexpected collapse always funnels power into the same outcome: more power for fewer players. more consolidation, more leverage, and less accountability. When you pattern match the last 120 years, you begin to see it. Crises aren't random events. They're pressure valves. They're reset buttons. They're opportunities. And nobody in American history understood that better than Wall Street. So here's the twist. The 2008 crisis wasn't just caused by bad mortgages or greedy homebuyers or even irresponsible bankers. No, the public story of 2008 is a distraction, a smokescreen, a simplified fairy tale told to a population too overwhelmed to look deeper. Because the real collapse, the true collapse, came from a hidden, sprawling, almost mythological network underneath Wall Street, the shadow banking derivatives pipeline. This pipeline allowed banks to create infinite leverage, hide risk from regulators, and build synthetic assets completely detached from reality. It was a machine designed to break and then monetize the breaking. This isn't a fringe theory. This is documented in the very architecture of the complex financial products used at the time, which multiplied risk hundreds of times over. But here comes the part they never told you. This system wasn't built by accident. It wasn't a side effect of financial innovation. It wasn't a mistake. It had architects, real people, real institutions, real names. And when you follow the paper trail, when you analyze the liquidity loops, the derivatives exposure, the synthetic leverage, and the shadow collateral, a single mastermind emerges behind the most explosive phase of the pipeline. A name almost never mentioned on television. A name that appears only in obscure testimony, forgotten memos, and buried shareholder letters. And the identity of that architect. You won't believe the name. Stay with me, because the receipt is wilder than you think. Now let's break down the mechanism, the how behind the operation. Because if you understand this section, you understand exactly how Wall Street engineered a crisis to control America. The shadow banking derivatives pipeline, how it really worked. The pipeline has 4 stages, each more dangerous than the last. Stage 1. Inventing fake collateral. In the early 2000s, Wall Street faced a problem. To expand profits exponentially, they needed more collateral. Real collateral cash, treasuries, gold is finite. But synthetic collateral, that's infinite. Enter mortgage-backed securities, MBS. But not regular mortgages, not normal credit. They created exotic instruments packaged from subprime loans. Then split them into tranches, magically transforming garbage into AA ratings. By 2006, over $1.9 trillion in subprime loans were circulating in the system. But even that wasn't enough. So banks created CDOs, collateralized debt obligations. Then CDO squared, a derivative of a derivative. Then synthetic CDOs, which had no real mortgages behind them at all. One synthetic CDO could multiply the exposure of a single mortgage 20, 50, sometimes 120 times. Imagine insuring the same house 120 times and collecting every time it burns down. That is the pipeline. Stage 2. Hiding the risk off the balance sheet. By the mid-2000s, Wall Street was sitting on a financial nuclear bomb. The risk buildup was too large to disclose. Solution? Hide it. They created off-balance sheet entities. SIVs, structured investment vehicles, conduits. SPVs, offshore entities. These entities didn't legally belong to the bank, but were controlled by them. Citigroup alone had over $100 billion in off-balance sheet exposure in 2007. Lehman, over $600 billion, AIG, more than $440 billion in derivatives exposure tied to synthetic CDOs. If these numbers sound abstract, here as an analogy, imagine hiding an elephant behind a curtain and saying the room is empty. That's how Wall Street hid tens of trillions of dollars in risk. Stage 3. The repo market. The real engine. Now here's the part almost nobody knows. The shadow system wasn't funded by deposits or savings. It was funded through the repo market. The repo market is a short-term lending system where institutions borrow cash using collateral, usually MBS or other securities, for ultra-short-term loans, often overnight. By 2007, the repo market was moving $7 trillion in overnight and short-term lending cycles. This meant one thing: if the collateral was fake, the entire cash flow of Wall Street was fake. And what was the collateral? You guessed it, the synthetic securities created in Stage 1. This is why the system was doomed. Stage 4, the trigger, engineered collapse. Now, here's the darkest part. The collapse wasn't triggered when the mortgages failed. It was triggered when large institutions, quietly, strategically, began refusing the collateral. They stopped accepting certain MBS and CDO tranches in the repo market. This forced liquidity to evaporate overnight, and guess what happens when liquidity dies? Banks fail, funds freeze, derivatives explode, collateral chains collapse. Everything burns. But here's the part they really don't want you to know. The institutions that rejected the collateral were the same institutions that created it. Let that sink in. Imagine selling someone a car, knowing you installed a bomb under the hood, and then refusing to drive the same model because you know it's going to explode. This wasn't an accident. This was detonation. Here's the fundamental truth. Wall Street's shadow pipeline allowed them to engineer collapses on demand and profit massively from them. The 2008 crisis transferred more than $10 trillion in wealth through loss of home equity, collapsed pensions, destroyed savings, and emergency bailouts. And guess where that wealth went? Straight upward, into the hands of the same financial institutions who lit the fuse. Because during the collapse, they bought assets for pennies. They received government bailouts. They used zero-interest liquidity. They acquired smaller banks. They consolidated more power. The top 1% saw their wealth increase by over $6.5 trillion between 2009 and 2019. Crisis wasn't a bug. It was a business model. And here's the final warning. If you think the system is safer today, if you believe regulators fix the loopholes, if you assume the banks learned their lesson, I have bad news. The system today is bigger, faster, more synthetic, and more leveraged than in 2008. Shadow derivatives, larger than ever, repo markets, now wired into global liquidity. Synthetic collateral, re-engineered into new instruments with new names. Names designed to keep you from connecting the dots. We are living inside a financial machine built on borrowed time. A machine where every boom is artificial, every bust is engineered, and every bailout strengthens the hands pulling the levers. If the past century taught us anything, it's this. The institutions that profit from collapse are the same institutions trusted to prevent it. So ask yourself, are we wiser now? Or are we walking the same path in better suits with bigger numbers and consequences too large to imagine? If you felt even a single moment of truth in this video, share it with someone who still believes the system is designed to protect them. And if you're ready for the unfiltered financial truth, the kind that shakes comfortable narratives, subscribe now. Because the next reveal is even darker, and it's coming.